Jason, when we look to explain the market, it seems like a lot of it keeps coming back to policy, but now also some of it looks to be supported by a turnaround and potential for that turnaround to escalate in the economy. When you talk with clients and investors who use your funds right now, are they chasing the rally? Are they piling more money into equity ETFs?
We're seeing some people looking for opportunities. There is certainly a fear of having missed out. Absolutely, we're well beyond those massive bargains that were the result of all babies being thrown out with all bathwater, basically in March and maybe early April. Right now, investors have the challenge of parsing this huge bifurcation that we're getting in the economy right now. You're seeing some firms, obviously, that are boosted by the current situation. A lot of sectors of the economy are getting hit really hard, and the Fed has, even the Fed and the federal government have this classic problem of trying to change behavior that monetary stimulus is going to have a difficult time changing. It kind of relates to the conversation you were having a few minutes ago with your colleague on crude oil. At the end of the day, those are physical commodity markets where supply and demand have to clear the market. And throwing some extra unemployment benefits into the system isn't necessarily going to get people on airplanes or in cars and go out and risking infection. And so we're seeing it again. It's a classic pushing on the string problem. Certainly, they're softening the blow. But when people are looking to invest right now, they're really having a hard time figuring out how to get exposure to the companies that are going to be viable over the medium and longer term, and avoid getting into some companies that have been hit hard and are also likely to struggle over the medium term because the stimulus packages just aren't able to address the underlying behavioral problems in the economy. There's been some, this is a sociologist's dream, right? Human behavior in the midst of a pandemic. The traditional reactions to flooding the system with money are not occurring this time around for obvious reasons.
What's interesting, Jason, is in 2019, when the Fed came to support the markets in late 18, it was the everything rally. This time around, with even more support, everything ain't quite what it used to be. It's basically just stocks. Treasuries haven't budged, gold hasn't budged, and we haven't really seen anything else budge. Stocks seem to be really the last play left. Thoughts on why that is? How come there's not incremental gains happening across all these markets if we're just getting inundated with money? At the end of the day, investors are making a specific decision, and it's going to U.S. stocks.
Yes. Well, the U.S. probably has the most dynamic, flexible framework and potent framework within which to address the problem. So it's not surprising Europe has structural issues that are a big headache. And the same goes for China and Asia. They don't have the transparency in those economies or necessarily the tools and the strength and resilience that the U.S. has demonstrated in crises in the past and currently. What's interesting right now, the way we're really looking at the markets right now is, again, I mentioned in March and April, it was buy what the Fed's going to buy before they buy it, because everything was cheap. And that was a fairly short window. Now where we're seeing the opportunity is in things like preferreds, high yield, emerging market debt, where you've got basically assets that the Fed isn't buying directly. You've got markets that are trying to truly accurately price the risk and reward and aren't being massively distorted by central bank interventions, direct intervention by central banks. And that was, now that we're 2 months into this, we're actually starting to see relative value emerge, and we're actually starting to see the markets get some sort of a handle on pricing the risk. And our base case is to see high yield defaults, broad high yield universe default rates rise to maybe around 10% over the next year to 2 years. Probably not surprising if you look around the street at different estimates. When you kind of back into the net total return after the defaults and the haircuts, you're looking at returns that are pretty reasonable. Certainly, right now, high yield exposure could outperform investment grade corporates, for example. I would say the same for U.S. dollar emerging market debt. Same thing, preferreds, you're getting excess of 5% yield. bank loans, excess right around 5% yield, and you're senior in the capital structure to high yield. So we're seeing flows into those markets that seem to be finding their way to pricing the risk in the specific issuers based on their sectors and the impact that the situation is having on those sectors. But energy, for example, no matter how much money you throw at people, they need to start buying oil and buying gasoline and traveling. And we're going to get that uptick, right? Things are getting better. But I really think that this is going to be a very drawn out process. We're looking at sort of 2 years before we see demand recover that could boost inflation and things like that. It's going to take time. People want an instant fix. The government wants an instant fix, but they just can't do it. There's no instant fix, but they can cushion the blow in the short term.
As they cushion that blow, Jason, with some of the other areas that now the Fed is operating in within credit markets, munis, high yield, to the point about not fighting the Fed, these seem like areas where you can very happily not fight the Fed, but still they haven't done as well as stocks. But I'm curious if investors think that's going to change. Have you seen big interest in Invesco's muni funds? Have you seen big interest in tax-exempt funds? I've heard the case here from folks that if there is a need to pay for all of this debt through taxes, then munis could get another second look by investors.
We're seeing fund flows reverse recently in munis, a couple of really good, solid weeks of inflows. And munis are dominated by retail flows, of course, because institutions rarely purchase tax-free munis. We saw the taxable muni market bounce back very quickly as a result of the fact that there's a high level of institutional participation in that market. Now tax-free munis are coming back. We're seeing a lot of clients really interested in high yield. Part of that, as I mentioned before, is that these are a few corners of the market that the Fed isn't purchasing directly. The Fed did set up a muni liquidity facility, which is short-term, up to 3 years, but short-term funding to essentially bridge munis over this really difficult drop in revenues in the short term. But they're not buying the long end of the muni market. So 7 to 10 year munis we think are very attractive right now. You're picking up almost 80 to 100 basis points of yield over investment grade corporates on a taxable equivalent basis, and those are AA munis versus single A corporates. So that's, we think, again, it's hard to get excited about 3%, but investment grade, that's actually pretty good right now. And if you look back over the last 10 years, it's not too bad either. We've been in low rates for a long time now.